Welcome back as we learn the methods to value a target company. We'll learn three key methods: comparable company analysis, comparable transaction analysis, and the premium paid analysis. Let's jump right in. After the initial evaluation step, where we identify if the corporate restructuring is material, the next step is to quickly determine a preliminary valuation for the target company or business segment. We'll learn three methods: comparable company analysis, comparable transaction analysis, and the premium paid analysis. In a nutshell, there are three key steps in comparable company analysis. The first is to identify the comparable companies, followed by calculating the various relative value measures of these companies to arrive at a valuation estimate for the target firm's shares. The final step is to determine an appropriate takeover premium and apply it to the valuation to arrive at the estimated takeover price for the target firm's shares. Let's briefly go through each of the steps. The first step involves identifying a set of other companies that are similar to the target firm. Ideally, these companies should come from the same industry as the target and have a similar size and capital structure. This set should be as large as possible, so if there are insufficient similar companies in the same exact industry, companies from similar industries may be included. After the comparable companies are identified, the next step is to calculate their relative value measures. Such measures can include price multiples like price to earnings, price to book, price to cash flow, and price to sales, and enterprise value multiples like EV to free cash flow, EV to EBITDA, and EV to sales. The specific multiples that are appropriate for the analysis depend on the industry that the target company is in. In addition, industry-specific multiples may also be used. For instance, the price paid per barrel of oil can be a useful ratio to consider in analyzing companies in the oil and gas industry. So, for example, if three comparable companies are identified, and these are the valuation variables, we can calculate the PE, PB, PCF, and PS ratios for the comparable firms. There's no fixed rule on how to apply these ratios to arrive at the value of the target firm's shares. One simple way is to just calculate the mean ratio for the comparable companies. Based on the valuation variables of the target itself, we multiply them with the comparables mean to get the estimated per share stock value of the target based on these companies. And if we assume the same weight for each of these estimates, we arrive at the mean estimate, which is $47.25. This value is an estimate of the target company's stock value relative to the comparable companies. A lot of these sub-steps are, of course, up to the discretion of the analyst. Besides the choice of the relative value measures, some analysts may prefer to use the median or range of values rather than the mean, and some analysts assign different weights to the valuation variables based on their importance. The last step is to estimate and apply a takeover premium to arrive at the final estimated takeover price of the target company. The takeover premium is to entice shareholders to relinquish control of the company to an acquirer. The takeover premium is estimated based on recent takeovers of similar companies. So, for example, if there are 4 recent takeovers of similar companies, and these are the prices of the company's stock prior to takeover versus the takeover price, the takeover premiums for each of these companies will be as such. And likewise, a simple approach to calculate an appropriate takeover premium would be to calculate the average. So in this case, the mean premium would be 32.2%. This means that the takeover premium should be $15.21 based on the market value of the target share price. If we add on the takeover premium to the estimated stock value, the estimated takeover price per share for the target company is therefore $62.46. As you can see, the comparable company approach is not too difficult. In practice, the hardest parts would be to find comparable companies and recent takeovers of similar companies. The calculations should be pretty straightforward. Let's have a quick exercise. You were tasked to propose a plan to acquire Smooth Corp. Given the relevant information for the comparable companies and recent takeover transactions of similar companies, estimate a takeover price for Smooth Corp shares using the comparable company analysis approach. Pause the video now and work out your answer. And we're back. Since we're only given the earnings, book value, and cash flow per share, we're only able to calculate the PE, PB, and PCF ratios for the comparable companies. Assuming they are equally similar to the target company, we just calculate the simple mean for the comparable companies. Check your calculations. And if we calculate the share price of Smooth Corp based on the comparable company's mean ratios, we get the following estimates. The mean of these three figures is $246. This is the market value of Smooth Corp shares based on comparable companies. Next, we calculate the takeover premiums. The two given takeover transactions had 25% and 30% premiums, so the average is 27.5% premium. Apply this premium to Smooth's estimated share price we calculated earlier, we get an estimated takeover price of $313.65 per share. And to conclude this lesson, let's discuss the pros and cons of a comparable company approach. Advantages-wise, it provides a reasonable approximation of a target company's value relative to similar companies in the market. This is a fundamentally sound approach. Also, data for comparable companies is easy to access due to filing requirements. And the estimates are derived directly from the market, rather than assumptions and estimates about the future which may be prone to errors. Disadvantage-wise, the approach implicitly assumes that the market's valuation of the comparable companies is accurate. As we all know, markets are prone to mispricing all the time, so the assumption does not hold true. The other disadvantage is that an additional step of determining takeover premium is required, which can be problematic because the data available for past takeovers may not be timely or accurate for the particular target company under consideration. Also, the analysis may be inaccurate because it's difficult for the analyst to incorporate any specific plans for the target, like changing capital structure or cost savings. To summarize, here are the 3 key steps in comparable company analysis. The first is to identify the comparable companies and to collect their data, followed by calculating the various relative value measures of these companies to arrive at a market value for the target firm's shares. The final step is to identify recent takeovers of similar companies to determine an appropriate takeover premium in order to arrive at the estimated takeover price. In this approach, the comparable companies are usually not the same as the acquired companies to determine the takeover premium in the final step. The comparable transaction approach is very much the same, but with the key difference that the companies identified in the first step are the ones acquired in recent merger transactions. For an analyst using this method, the biggest challenge is finding enough relevant takeover transactions for firms that are similar to the target. Ideally, all of the takeovers will involve firms in the same industry as the target and have a similar capital structure. However, these sorts of deals can be difficult to find, so the analyst will have to use some judgment as to what recent merger deals are most applicable to the analysis. Step 2 is the same, that is, to calculate the relative value measures for these companies that were acquired. However, note that they should be based on the final takeover price of the shares of these similar companies, not the market price. And since the takeover prices have already been priced in the takeover premium, we should not add on takeover premium again. The estimated share price of the target from Step 2 is the estimated takeover price. So essentially, the comparable transaction approach has just 2 key steps. Since the steps are so similar to comparable company analysis, let's jump straight into the practice. You were tasked to propose a plan to acquire Smooth Corp. Given the relevant information for recent takeover transactions of similar companies, estimate a takeover price for Smooth Corp shares using the comparable transaction analysis approach. Pause the video now and work out your answer. And we're back. The important thing for comparable transaction analysis is to base the valuation measures on the takeover price, not the market price of the target company's shares. The market price is simply given to test your understanding, so we don't need them to answer the question. Since we're only given just the earnings, book value, and cash flow per share, we use them to calculate the PE, PB, and PCF multiples for the acquired companies. Assuming they're equally similar to the target company, we just calculate the simple mean for the acquired companies. Check your calculations. And if we calculate the share price of Smooth Corp based on the acquired company's mean ratios, we get the following estimates of the takeover price for Smooth. The mean of these 3 figures is $309.58. This is the estimated takeover price of Smooth Corp shares based on comparable transaction analysis. Let's discuss the pros and cons of the comparable transaction approach. Advantages-wise, we've mentioned that since the past takeover prices already incorporate the takeover premium, there's no need to estimate a separate takeover premium. Also, the estimates are derived directly from the market, rather than assumptions and estimates about the future which may be prone to errors. And since the takeover price has a reasonable basis of being in line with past takeovers, there's less risk of a lawsuit being filed by shareholders for mispricing the deal. Disadvantages-wise, the approach implicitly assumes that past transactions are priced reasonably. If past transactions were mispriced, the mispricings will be carried over to the estimated value for the target. Also, there may not be enough comparable transactions to develop a reliable data set. Some analysts may use transactions from other industries, but these may not be that appropriate. And lastly, the analysis may be inaccurate because it's difficult for the analyst to incorporate any specific plans for the target, like changing capital structure or cost savings. The third and simplest method is the premium paid analysis on the sale value or acquisition price that was announced. We call this the deal price. The stock price of the target company before the announcement is known as the unaffected price. A takeover premium is simply calculated as the percentage of deal price that is above the unaffected stock price. This method is only applicable to companies with liquid publicly traded stocks. For example, if the shares of the target were trading at $40 just before the announcement and the deal price was announced at $50, the takeover premium is 25%. However, stock prices may be affected by rumors and speculation before any official announcement. To exclude such effects, it is common to use the stock price 1 week before the announcement, or even the average price for a few weeks before the announcement. The takeover premium should be compared against the takeover premium in past transactions in the industry. If the premium is much higher than the industry average, the acquirer may have overpaid for the shares. And that's the 3 preliminary valuation methods to quickly value a target company. In the next lesson, we shall move on to the last step, that is, to model the pro forma financial statements.